In today's video, we're going to talk about an effective strategy you can use to make your retirement investing more tax efficient. Let's get into it. For many retirees, taxes will be one of your biggest expenses in retirement, if not the biggest. Taxes can be reduced, however, if we understand the tax implications of each retirement bucket that we have, and then we use those buckets to our advantage. In most cases, the biggest thing we are trying to manage when we talk about retirement tax planning is forced income. Now, your tax-deferred accounts like 401ks and IRAs have forced income in the form of required minimum distributions that take place in your 70s and beyond. Your taxable account has forced income in the form of ongoing taxes during growth. Dividends and interest in a taxable account are taxable annually, where they are not taxed annually within your IRAs. So, for instance, $20,000 of interest has a different impact based on where that interest happens. On the screen is a tax rate breakdown of the various rates you will see in taxes from each account. The main account here to note is your taxable account. Interest and short-term capital gains are taxed at the rates in red, which have the highest tax rates at higher levels of income. The orange rates are more preferred rates. When we are paying taxes from our taxable account, we generally want to make sure we're shifting around our situation in a way to make sure that we're only paying the long-term capital gain rates, or the orange rates. From these basic ideas we've discussed, we come to this general idea of something called asset location. Now, in this video, I hope to solve a problem that I hear from a lot of investors trying to optimize their asset location. Now, asset location is the idea of putting the right investments in the right accounts to reduce taxes over the long term. For instance, you don't want to put high income yielding assets, whether that be high interest or high dividend yielding assets, in your taxable account. Generally speaking, you want to have these within your IRAs so they're protected on an annual basis. You want to have then lower yielding assets like, let's say, growth stocks within your taxable account instead. Higher yielding assets generate more forced income. For instance, here is a general asset location mapping for a stock allocation. I say general because you will likely have a differing tax bucket composition or maybe even asset allocation that may cause you to be forced to locate assets differently. But in general, you want the highest growing assets within your Roth IRA. After all, your Roth IRA is a tax-free account, so if we can grow that account by 10% instead of 8%, we end up with a lot more tax-free dollars long term. Then in your taxable account, you want to try to keep that dividend yield as low as possible. Every dollar of dividends is taxable to you in a given year, as we've already discussed. With a big enough taxable account and a big enough dividend yield, you can easily add tens of thousands of extra income to your tax bill, and that's the case whether you utilize that income or not. The higher dividend yielding stocks should instead go within your traditional IRAs or maybe even your Roth. But here is a mental roadblock for some. Let's say our withdrawal strategy calls for us to pull all of our income from a taxable account. And let's say as part of our income plan, we plan to live on the dividends that our stock portfolio is generating. Well, how do we asset locate properly but still withdraw from the account that we want to withdraw from? We use the strategy that is the focus of today's video, relocation. Let's walk through a simple example. Say that you own the ETF SCHD in your IRA. Now, SCHD has a 3.5% dividend yield, which would generate about $14,000 in annual dividend income relative to the balance we have within this ETF. Well, if we have this position within our IRA and the income is generated within our IRA, does this mean we have to withdraw from our IRA? No, we can relocate it. On a quarterly basis, SCHD generates $3,500 in dividends. Each time this dividend is released, you would basically go ahead and let that dividend go to cash in your IRA. You would then go in your taxable account and sell $3,500 worth of growth stocks. Now, this may generate some small capital gains, but it will be far more tax efficient than taking the full dividend, as I'll show here in a second. At the same time, you buy back into growth stocks within your IRA with the dividend that went to cash. So basically what's happening here is we're maintaining the exact same growth stock allocation, but now you have $3,500 of cash that you can now withdraw from your taxable account. Voila, you've stayed tax efficient and followed your withdrawal strategy. And the reason selling stock is more tax efficient than a dividend is because a dividend is 100% taxable. When you sell a stock, you have a portion of that stock that is going to be cost basis and therefore non-taxable. So by selling a stock rather than taking a dividend, you end up with more income after taxes. In the example on the screen, the total difference is 7.5%. Now, this difference will vary based on your cost basis relative to the unrealized gains that you have, but nonetheless, just know there will always be a gap or a benefit from selling stock versus taking that given dividend. And so let's say we compound this difference in taxes each and every year in retirement. Well, the benefit of this strategy can be quite large. Now, note this strategy is most important for those with larger assets or larger balances. The benefit for someone that has, let's say, less than $1 million in retirement assets will be less. So I want to make that clear here. But this idea can be applied even more effectively when we think about using safe assets in our retirement income stream. I'll show an example using simple bonds here. If we look at asset locating bonds, a similar logic applies to that of stocks. We generally don't want safety in our Roth unless we are withdrawing from our Roth in the short term. Again, we want this account to grow as much as possible. Safety generally will grow at a lower rate. Then we don't want high interest-bearing investments within our taxable account, so generally muni bonds are most recommended here, although there is an asterisk that I'll explain momentarily. This leads us to generally want to locate safety into our IRAs, traditional IRAs specifically. Safety generally grows at a slower rate, so locating safety to our IRAs also helps in a sneaky way with RMD minimization. A smaller IRA leads to obviously a smaller RMD. But let's first focus on the asterisk on the muni bond side. If you are forced to put bonds into your taxable account, your immediate answer should not be muni bonds. You should run the math and calculations. Muni bonds are generally thought to be best here because they are not taxed federally. So it seemingly eliminates the forced income problem. Well, this is one of those situations we can't let the tax tail wag the dog. If I look at a comparison of target date bond ETFs that mature in 2024, currently a treasury bond offers a 2% higher yield. Now the treasury will be taxable at the federal level. So the decision to go treasury versus muni bonds comes down to the tax rate you will pay on the interest. If you are paying a tax rate on that interest of less than 38%, you should actually go the treasury bond route. Keep in mind, this also isn't an apples to apples comparison. Muni bond interest is clawed back and counted in tax equations like IRMA and Social Security taxability. They're also a riskier bond than a treasury bond. They have a higher chance of defaulting, whereas a treasury bond really has the lowest chance of defaulting in most professionals' opinion. The point being here, however, the tax rate matters in this equation. But let's go back to our relocation example. Say we have bond ladders for our income over the next, let's say, 4 years in our IRA. Then we have growth stocks within our taxable account. But once again, we want to pull our income via that bond ladder, but we want to pull it from that taxable account. So once again, how do we solve this problem? Effectively the same way we did with the dividends. We let that bond mature within our IRA and we leave it in cash momentarily. We then sell the given amount within our taxable account and withdraw the monies for our income. Back within our IRA, we then buy back in what we just sold within our taxable account. By doing this, we end up relocating to the taxable account while still keeping the overall allocation as we first intended. This can have a massive impact for specific retirees. Let's say that you have $800,000 in fixed income investments for that safety within your portfolio. If you locate all of that to your taxable account, that could be $40,000 plus an extra income that you have to pay taxes on annually. Using relocation can minimize or even completely eliminate this added forced income. Now, there are some risks or problems that you need to be aware of. The first, be aware of wash sale rules. Let's say that you sell a growth stock ETF in your taxable account and you ended up selling it at a loss. Well, this is great for your taxable at the end of the year because we're able to tax loss harvest and thus lower income or at least offset other capital gains. But you can't immediately buy back that exact same growth ETF in your IRA or that tax loss will be wash saled and prevented. So you need to buy back a growth stock ETF that will have similar performance while not breaking those wash sale rules. If you are selling an investment as a gain, you do not need to worry about those wash sales. Second, the biggest worry or objection I see from investors when we talk about relocation is what happens if you're selling that growth stock during a bear market. Imagine you have a $500,000 brokerage account and growth stocks are down 30%. That $500,000 is now only $350,000. Well, if we relocate that $100,000 in bonds and then spend it from that taxable account, now that taxable account is even smaller at $250,000. And now we have relocated stocks that are down 30% into your IRA. once we see a recovery within your IRA, doesn't that mean your IRA is going to be that much bigger? And now we have a bigger RMD problem. So now we just traded one problem for probably a bigger problem ultimately. Is this a valid objection? Well, potentially, but it depends on your situation. Let's say you are in a position where you are in the midst of fairly large Roth conversions. With the situation I just described, actually relocating improved your Roth conversion plan. Our goal in general is to exhaust that taxable account for most because it's a fairly leaky bucket. If I were Roth converting, let's say at the tune of $150,000 per year, as soon as I relocated those growth stocks into that IRA, that's exactly what we'd want to target for the Roth conversion. Now, rather than have that recovery happen in the IRA, we have that recovery happen within the Roth. And so we basically ended up relocating to convert assets at a discount. We ended up with that relocating not only helping us from the annual tax situation, but now in our larger Roth conversion strategy here as well. The place that we can get into trouble with this relocation strategy is during, let's say, Affordable Care Act years. Let's say we are trying to use our taxable account to earn a big ACA subsidy for, let's say, a 5-year stretch, and we really don't have that much in Roth assets. Well, in this situation that I just described, we will want to withdraw everything from the taxable account to earn that larger subsidy because in terms of the reported income formula, that taxable account won't be fully counted, where pulling a dollar from IRAs would be counted dollar for dollar. And so with the situation I just described, we took a $500,000 taxable account down to $250,000 in just 1 year. We probably just torpedoed our subsidy for at least 2 of the remaining 4 years that we need to earn that subsidy, thus probably costing us tens of thousands in healthcare savings. In this particular situation, we want to maintain the value in that taxable account for other reasons. We might find it better to forego relocating and simply add the bonds to the taxable account. Even though it is slightly less tax efficient, there are other reasons that we want to maintain that taxable account and make sure that $500,000 is there when we need it. And what I just described is really a classic outcome for most strategies in retirement. Almost every strategy that can be powerful in one situation can be shown to be a less than stellar strategy in another situation. The key isn't just being aware of the strategies available to us, but also knowing the right time to use those strategies. Now, I hope the strategy in today's video helps you build a more tax-efficient retirement. But if you're looking for further education on managing your taxable account as efficiently as possible, click one of these 2 videos right here. Thanks for watching, and always remember, you don't need more money, you need a better plan. Look forward to seeing you in the next video.